Now, in the taxation of the bank, generally we ask ourselves, what is a bank? Bank is usually considered to be a financial institution that normally accept deposits from the customers. So customers who have excess money can go deposit their money in a bank. And for those people who normally have deficits, for example, they need a money and they don't have it, they can go to a bank and borrow one. So we want to see how are these institutions which accept deposit and give out loans usually subjected to tax. So points to consider in the taxation of the banks are as follows. So points to consider. So that is now the general definition of a bank, that where you, if you have excess cash, you go make a deposit, and if you want a loan or you have a deficit, you can take a loan or an advance to fill in that deficit. Now, point number 2 that we need to know. Yeah, so point number 2 we are saying is that banks are usually taxed at the corporate tax rates. And that's the reason why we are looking at them under specialized companies. So they are companies themselves, only that they specialize in banking activities. So they are taxed at the corporate tax rate of 30% if they are resident banks. And if it is an unresident bank, then it's supposed to be that 7.5%. So these rates are usually applied on what? They are applied on taxable income. So we have the point number 3 to note. So the corporate tax rate that we have said, which we normally apply to determine the tax that is payable by a bank, is usually charged on the taxable income, just like any other business. You have to determine the taxable income and then apply the rate to get the tax. So how do you get the taxable income, which you charge tax? Like any other business, you either use the net profit method or the gross profit method. And as we have been saying, net profit method we use if you are given an accounting profit. If no accounting profit is provided, then automatically you know that you're supposed to use the gross profit method. So that is the point number 3. Point number 4, you should know about the taxation of the bank. That bank being a specialized company, we have some incomes which specifically apply to a bank, which does not apply to a general business. So those are the ones that we call additional taxable incomes. Those are the ones that we now need to add to the ones that we said are for general business and which are taxable. Like I remember we said discount received is a taxable income. Foreign exchange gain is supposed to be a taxable income. So other than those one, for a general business, when it comes to the bank, which one are specifically for the banks and which are usually taxable? The following are the ones. So the first taxable income, additional taxable income for a bank, is number 1, all interest incomes from all the sources. So for a bank, when it gets the interest, it is as a result of that it had done some lending. So what we are saying is that any income it gets from that lending is supposed to be a taxable income, and it is usually considered to be operating income. So all interest income for a bank are operating income and taxable because it is doing what it is supposed to be doing, lending. So don't differentiate investment interest and operating income when it comes to a bank. All of them are considered to be operating and they are all taxable income, except one. Note, except one, interest income from abroad. That is the only interest income which is not usually subjected to tax from abroad. Otherwise, any other is taxable. So what are the examples of these interests? They are the one that I have listed here. Interest on customer loans and advances. So if somebody wants a loan, go to a bank, take that loan. The bank normally charge them the interest. That interest to the bank is an income, and we are saying it's usually a taxable operating income. Another one is interest on deposit in other bank. One bank can go deposit money in another bank. So when it deposits money in another bank, it expects to get interest. So the interest that it gets is usually a taxable income. Another one is interest on government securities. So sometimes the bank can lend to the government. How does the bank lend to the government? People lend to the government, or person can lend to the government through buying government treasury bills and bonds. We call them securities. So when the bank lends to the government and it gets the interest, that is usually considered to be an operating income, and it is usually a taxable operating income. So that was number 1, additional taxable income. Number 2 of the additional taxable income is So another taxable operating income for a bank is the realized foreign exchange gain. That if normally banks deal in foreign currency, in the process of dealing with the foreign currency, sometimes they can have a gain when they sell a foreign currency. As long as the gain has been realized, it's a taxable income. So what we don't tax if the gain is unrealized gain. That we said even for other businesses, they are usually not taxable. Another taxable income, number 3, fees and commission income. That is usually a taxable operating income. And this is usually for the services rendered by a bank to the customer. For example, when a customer goes to a bank and want to withdraw money, they usually charge some fee, some commission. That is usually an income to a bank and an operating income and a taxable operating income. Same case, for example, if somebody wants to withdraw money, for example, through the ATM, you are also charged some bank charges there. So to the bank, that is supposed to be an income and it is usually a taxable operating income. Number 4, we have the discount on bills discounted. That is usually a taxable operating income for a bank. Now, how does the discount on bills discounted normally comes across? Now, you normally find that if you are a customer of a bank and you are a business person, sometimes a customer can give you an invoice. Now, invoice is a bill and tell you that, well, or you give a customer an invoice for that matter. You give a customer an invoice, and that invoice, that means that the customer is supposed to pay you in the future. Maybe the customer can tell you that I'm going to pay you in 6 months' time. The value of the invoice, 10 million. But maybe after 1 month, you want that cash. You have an emergency. So what do? Instead of waiting for the 6 months, you can go to a bank. Agree with the bank that you're going to give them that invoice that is of 10 million, and then they give you the cash. After the time period of 6 months, that is now after month that is supposed to be 5 months, the bank would present the invoice to the customer who you had sold goods to on credit, and they are going to be paid. And because the bank is in business, it cannot give you the real value of that invoice. So they cannot give you the 10 million. Most of the time they negotiate, they give you like 9 million. So because, they have to wait for another 5 months to be paid. So if you agree, you are given 9 million, you go away. So after that, the bank get that invoice. After the 5 months, they are going to present it to the customer and they are going to be paid 10 million. So when they are paid 10 million, remember they gave you 9 million. So the difference of 1 million is what you are calling the discount on bills discounted. It's an income to a bank and it is usually a taxable income. So that is supposed to be point number 4, additional taxable income. Then we have now point number 5. Point number 5 of the point that we should note, probably I should change this one to Roman so that at least you can be able to differentiate between the ones that we have indicated and the continuation of what we had here. So this is supposed to be Roman 1, Roman 2, Roman 3, Roman 4. So those are under the point number 4. So we have the point number 5, additional allowable expenses. So the additional allowable expenses for a bank, we are saying, other than the normal allowable expenses that we discussed at a general business, like electricity, the rent, the capital allowance, they are those that are specific to a bank, and they are usually allowable expenses. So what are they? Number 1, we have all interests. Yeah, so what we are saying that all interest expenses when it comes to a bank are usually allowable expense. Just like we have said that all interest income are taxable. So all interest expense are usually allowable because it is as a result of bank advancing what it was formed to do. Accepting the deposit, in which case they give the interest. So we are saying these are the example of interest expense, like interest on customer deposit. When the customer deposits their money with a bank, like fixed deposit account, saving account, or even current account, it normally earns interest. That interest to the bank is an expense because they have to pay to the customer, but it is usually a allowable expense. Same case when we have interest on deposit by other banks. We said that This bank can go deposit in another bank, in which case we say it is supposed to be a taxable income. Now, when another bank come and deposit in this bank is supposed to pay the interest. That interest is an expense to this bank, but it is usually an allowable expense. So that is supposed to be number one of the additional allowable expense. We have number two, contribution to deposit protection fund. This is a contribution that is usually done by a bank in order that in case, for example, something happened to that bank and the bank collapses, then where they have deposited this amount to protect the customer fund, this is supposed to pay the customer their money. So when they do that, they are just carrying out what they are supposed to do, trying to protect the deposit of the customers. So that contribution is supposed to be an allowable expense. We have another allowable expense. Another allowable expense is realized foreign exchange loss. Now, we said when you have a gain which is realized, a taxable income. Now, instead of making a gain, sometimes you can change foreign currency and make a loss. As long as the loss has been realized, that's supposed to be an allowable expense. But we are saying if it is unrealized foreign exchange loss, that is not supposed to be an allowable expense. So after that, we have the point number 4. Where we have the loss on disposal of securities. Now, security is usually provided by the customer. If you want to take a loan, for example, from a bank, they will ask you, provide a security. Security are usually in form of what? In form of a fixed assets like land, so you provide the title. Car or motor vehicle, you provide a logbook. Now, if the bank give you 10 million, and then you're not able to pay the 10 million, they will be forced to sell your land you provided as security, or the car that you provided as a security. Sometimes they may not be able to recover the whole amount. So if the loan is 10 million, they may sell, for example, the land and get 9.5 million. So the difference of 0.5 million is a loss on their side, but they incur that loss in the normal course of their business. So that is supposed to be an allowable expense. It's also called the collaterals. Now, don't say that that's a fixed asset. Remember, it is something they deal with in the business. Now, taking the security for the loan. So that is not a fixed asset, which we said that the loss is not allowable. So this is security for the loan that has been taken. Then we have the number 5. Rebate on bills discounted. Rebate on bills discounted, I normally say that it is the opposite of the discount on bills discounted, which we said is usually an additional taxable income. So if the bank make a discount, it's an income. But sometimes the bank, like the invoice we talked about, when you give them an invoice of 10 million, sometimes before the 6 months or 5 months lapses, they may be in need of cash. So they can look for another bank to transfer that invoice. And when they transfer, probably instead of getting transferring at 9 million they gave you, they can transfer at 8.5 million. Whereby now, it means that they're going to make a loss of 0.5 million. That 0.5 million is the one that they're calling the rebate, and it is usually an allowable expense. So these are the points that you need to know when you are taxing a bank.